Welcome to SB Talks. Today is Wednesday, November 5th, and I am joined, as ever, by our Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vinny.
Now, today, Nick and I will be discussing the Reserve Bank. We had no Cup Day rate cut, but where to from here? We'll chat about US earnings season and fears over potential market bubble, as well as talk of cockroaches in the credit markets. Hopefully that doesn't put you off. Welcome to all our listeners. So we had no Cup Day rate cut yesterday. Not any great surprise given the September quarter inflation data that we saw last week. But unpack your thoughts around just that broader data and where it leaves the Reserve Bank going forward.
Yeah, so, excuse me, it was no great surprise given the strong trim mean imprint for the September quarter, which came in at 1%, and that compared to 0.6 that the RBA had in their forecasts in August. So we got a new set of forecasts from the RBA that shows that they expect inflation, trim mean inflation, which is their measure of underlying inflation, to track at about 3.2% through till June of next year. So that's not heading in the right direction. That's not 2.5%, and based on their longer run forecasts, they're only seeing it get down to 2.6% by the end of 2027. So we got a new set of forecasts. Michelle Bullock at the press conference, which I watched, said that there was some noise that she thought in that September number, maybe some temporary factors
that are distorting the quarterly numbers somewhat.
Yeah, so I think she wants to buy a little bit more time to see whether some of those things unwind next quarter. But
she'd previously been on the record to say they were hoping for 0.6. She said 0.9 would be a material miss, or words to that effect, and they got a worse result than that.
They did, and so there was a couple of things in there that she kind of called out. One is what they call market services inflation, which is the stickier part of the sort of inflation basket, which is not really moving too much. And she called out dwelling construction costs, which have sort of gone back up again. So I think, she also discussed that the sort of lag effect of the prior rate cuts earlier this year, the 3 rate cuts, are still kind of coming through.
So that's the rate cuts come through, people get a bit of a boost, as you've talked about on the podcast before, to their discretionary disposable income, which impacts their discretionary spending. Excuse me. But that's a factor.
That's right. And so, even though we got that spike in unemployment rate from 4.2, 4.3 up to 4.5, she didn't seem particularly concerned about that. She still characterised the labour market as on the tighter side. So they do seem more worried about inflation, and want to, I guess, just buy more time, really, just to see whether some of those temporary factors unwind.
So markets had been previously pricing in, a fairly significant probability of a cut, but once that inflation data came out last week, that was really off the cards. Yeah,
that's definitely been off the cards since then. And, we now have just 4 basis points priced for December. So
low probability of any action.
Pretty low probability. There's not a lot of data between now and then anyway. And really the first full cut is not until August of next year. So, and
if at all. So we're heading into pretty significant data dependent territory.
Yeah, and she actually discussed this at the press conference, saying she didn't think policy was that restrictive, indicating that the neutral rate could be roughly where we are today, or maybe a little bit lower. So didn't really feel like there was a great need. She kept saying that we didn't raise rates as high as other countries, therefore we don't need to cut them as much.
And that's true. And that is true. Yeah. And there's obviously, we've talked about in the immigration and the other factors affecting our economy. So we're probably heading into a period now where they're going to assess where that neutral rate is based on how the economy is tracking.
Yeah.
Across the ocean, the Federal Reserve policymakers voted for a 25 basis point cut last week, but tempered expectations potentially in terms of where their trajectory would be going from here.
Yeah, I think there's still a degree of uncertainty there as well. Very similar to Australia in many respects. Inflation is too high. It's tracking around 3%, 3.1 in the US, so above their target. There's still some, Fed speakers. We had Lisa Cook last night saying, she thinks that the tariffs have still yet to fully pass through into prices. So there's still more to be seen there.
There's probably plenty of evidence of that still, question marks of where companies are absorbing it and the consumers not really seeing it yet.
Yeah. And, and Chair Powell said that, December at the press conference, December is definitely not a foregone conclusion. So he kind of really hosed that down. And also, they're obviously still in that, government shutdown. There's no data around inflation or the labour market that's coming through. So he used the expression, when you're driving through the fog, you need to slow down, suggesting that, there's a good chance that they might do nothing in December. So we've seen some repricing in the bond market. Bond yields have risen on the back of that. So that I guess makes sense. And we've had a few other Fed speakers also saying, they really don't think that there's a need at the moment for follow-up rate cut in December.
And it might take a bit of a cautious path forward, probably appropriate, and then we'll see what the makeup of that board is as we enter into the new year and some terms potentially come to an end and new individuals are added.
Well, that's right. I mean, Lisa Cook, who I mentioned, there's still a Supreme Court case about whether she can be removed by Trump for cause or lack of cause, So that's still to play out. And then, we know he's still considering, I think, 5 candidates to replace Chair Powell in May. So there's all of that to play out as well.
But the US had risen further. They started cutting sooner, but, I've taken a meaningful bit down from where they previously were. So it is getting to this period now where they probably should be slowing down, and particularly with all the factors at play in their economy, as you've articulated before. It's probably sensible that we see sort of a cautious approach from here, even if that's not what the administration might ideally seek.
That's right. Yeah, they've had 150 basis points of cut so far this cycle.
Now, earnings season. Broadly a positive picture. We've got a market that's beginning to have more question marks over the AI rally, and is this a bubble? It's increasingly getting headlines and comments. Well, how's the earnings season shaping up before we maybe step across that broader topic?
Yeah, so US third quarter earnings season, we're 71% of the way through that. It's been good. 84% companies beaten. That's above the long-term average. We've seen growth in revenue tracking around 8.2% year on year, excluding the energy sector, which is quite volatile. And earnings are tracking around 14.7% higher than last year, excluding energy. Strong results, and so, when we do talk about, the AI bubble and all that sort of stuff, when you look at those numbers, you can see why the market's been as strong as it has, and particularly, with the rate cuts we just discussed, with sort of reduced trade tensions, with economic resilience, markets have really liked that, and that's sort of been one of the reasons why the market has continued to drive higher this year.
Has remained as resilient as it is, albeit it's fair to say the market has baked in fairly lofty expectations, particularly for some of the companies in the technology sphere.
Yeah, so we saw a few of those companies, those Mag 7 companies, report in the last couple of weeks, and the results generally were pretty good. There was a few sort of divergences. So Amazon had a really good result, and its shares kind of rose 10%. Meta had an equally good result. Its shares were down 10%, and there are increasing concerns about the amount of capital these companies are spending to kind of drive forward in AI.
So building data centers and buying NVIDIA chips.
Well, that's right. So just to put this in context, the 4 big hyperscalers, Amazon, Meta, Microsoft, and Google, are on track to spend $350 billion in capital expenditure this year. That compares with, they spent about $70 billion in 2020. So a significant increase, and a lot of them guided in their most recent results for even more spending in the year ahead. So
your spending trajectories that they're guiding to are eye-popping. Obviously, question marks over whether that all plays out, but very capital intensive.
Yeah, I think with Amazon and Google and Microsoft, you can say, well, at least they have cloud businesses, AWS, Azure, Google Cloud, and so
they have a service to sell.
They have a service to sell. In the case of Meta, They don't. They produce advertising and content, and so it's not clear why they need to spend so much on AI. Is it really needed to generate more advertising content?
It's an interesting question. Do they just see it as an existential threat, therefore they feel like they just need to be here spending this money doing it for the sake of their own survival, but question marks over what's the road to monetizing this?
Well, that's right, and that is what Mark Zuckerberg's talked about, almost existential. He's happy to keep spending for the time being, and when questioned from analysts as to what the payback is, can't really articulate that, and that's why Meta shares were down last week.
And when you have an organization that's running such huge EBIT margins and you've got this cash flow, it's a lot easier to make those decisions than if you're running a historical traditional business of lower margins and lower cash flow and you're having to go to the market to finance some of this spending.
Well, that's right. And Meta did go to the bond market last week to raise $30 billion for a bond issue. They're also doing some of these sort of off-balance sheet deals with groups like PIMCO and BlackRock to finance data centers that don't sit on their balance sheet. So there is some concerns that there are parallels to the dot-com bubble when you see some of these sorts of things creeping in.
The infrastructure build-out that went on at that time of laying the cable and other things, which eventually all got used, but for a period of time there was probably an overbuild.
Well, that's right, and the payback was quite long. Yes. It's like when the personal computer came in, great, but it took 15, 20 years before it really started to boost productivity and to get monetized. So there's some parallels.
Can I take a step back from that, if I may, and then ask you to put your chief investment officer hat on, if I can. And how do you think about this when you look at the market and the strength there's been in the market? Your comfort on, I guess, remaining invested, and a caveat over the top of that is, of course, you have to invest somewhere. So if you're not invested there, where do you go? Yeah,
for the time being, we're comfortable. I'm comfortable remaining fully invested in equities. As I do see that this AI runway has further to run. It's not something that they're just going to switch off tomorrow. And based on the demand that's coming through for some of these companies, it does seem like they have there are returns potentially from some of these investments. So I think, for the time being, we're happy to remain invested. I do go back and look at, the dot-com bubble. Alan Greenspan, who was the Fed chair back in the 1990s, talked about irrational exuberance in December 1996. And the dot-com bubble didn't pop until March 2000, three and a bit years later. So these things are very hard to time. And if you get out too early, that's the same as being wrong. You might eventually be right, but you might miss a lot of the returns that come subsequently. So we're alert to the risks. I do look at some of these things, like, for example, meme stocks are up 71% this year. Unprofitable tech companies up about 60%. The Mag 7, which does have real earnings, up about 25%. Before last night's pullback. The S&P up about 16. The equal weighted S&P, which is sort of the average stock, only up 8.5.
Yeah, and that's worth clarifying that one. So obviously the more heavily weighted end of the market is the big tech, and the rest of the market hasn't risen nearly as much. But you do paint a picture there that there's a bit of a junk rally with meme stocks and other non-profitable companies having risen quite strongly. So it probably paints a picture where at some point there's a rationalization point here, and that means that potentially everything gets sold off somewhat in that process, but it doesn't all stay sold off in that process too. And you're never going to time that perfectly, so you're trying to be selective about how you're invested into it. Yeah,
that's right. So we're keeping an eye on it, but we're not overly concerned at the moment, even though, last night we had 2 CEOs from banks, Goldman's and Morgan Stanley, warning of bubbles. There's more and more people in the press warning of bubbles. Which is probably a healthy thing in some ways, if you think about it. Maybe make people a bit more cautious in how they.
Well, here's an example of how it plays straight through from some of the mega scalers. If everyone becomes a bit more cautious, maybe their capital rollout slows down, and that will slow down obviously the evolution and the rollout of AI. But it'll help bring things a bit more into equilibrium. So the market has the potential to do those sorts of things.
That's right. It can self-correct. Yeah.
If you're a non-profit making tech company, it's not going to do anything for you. You're just gone, and perhaps some of those need to be cleared out as well, and that's probably what they're calling for.
Yeah.
Now, we've spoken on the podcast previously when looking at valuations and talking of bubbles, your preference for mid-risk assets, in particularly areas like private credit. And it's been in the news in recent weeks, the credit markets more broadly, and you wrote about it in our SB News last Friday, and particularly Jamie Dimon, JP Morgan's CEO, talking about the cockroaches in the credit market. Can you expand on that?
Yes, well, he used the expression, when you see one cockroach, there's usually more, referring to some of these problems that we've seen in the press around various companies that have gone bust recently, notably First Brands, which is selling car parts, and Tricolor, which is a business that JP Morgan actually lost money on, 170 million. So you know, in each of these cases, First Brands, Tricolor, another company called 777, which I discussed in the article, a couple of real estate funds in California, and since then 2 more have popped up where BlackRock and BNP Paribas also exposed. So this isn't just private credit; these are banks actually getting caught up
the credit market more broadly.
And so I think it's a lot in almost all these cases there was fraud involved, where assets were double pledged. So
explain that for us.
So it's like you have a car and you go and get a loan against that car
from one provider,
and then you go and get a loan against the same car from another provider, and the two don't know that they actually
so structural
security over the same car.
Structural weaknesses in the system that have failed to pick this up.
Yes, that's the problem, and fraud has allowed this to happen with falsifying of records about cars and invoices which have been sold or borrowed against. So there has been fraud. And I think that it is a wake-up call when there's too much capital chasing too few sort of lending opportunities, maybe standards get relaxed a bit too much, and then you get these sorts of scenarios popping up. So I think it is a wake-up call, not just for banks, but also for the broader private credit industry that is providing this finance to really make sure that they're trying to avoid fraud, although it can be very difficult to avoid.
Well, I think you're talking, and you made a couple of very important points there, is I think when you get over-exuberance and too much capital flooding into a space, and then standards can fall, and potentially your returns obviously are impacted by that. Maybe it is worth setting out when we invest in private credit, what we look for in managers, particularly around, I guess, their experience, their history through different cycles, and their diversification.
Yeah, so definitely we look for institutional grade managers that have robust practices and systems that have been doing this for a long time, that have been through cycles, that have people dedicated to dealing with problems.
Talk about workouts and those sort of problems.
Well, generally, when you're lending money and you're earning, the cash rate plus another 5-6%, these are borrowers that cannot get traditional financing from the bond market or from banks at lower costs. So you're dealing with riskier borrowers.
It's higher risk.
You're dealing with higher risk. So you need people that know how to work with those borrowers if they run into troubles, and try and recover their money, and have strong lending covenants, legal documentation, monitoring of the borrowers, so they're getting the monthly reports on how they're tracking. They can get in early if they see signs of weakness. So there's a lot of levers that these firms have and a lot of experience, and that's what we look for. And we also look for companies that maybe are highly diversified.
Yes.
So in one case, we have one firm that has 700 underlying exposures. We know some of them might have problems, but it will
some of them inevitably will.
Inevitably, but it will be not impact the whole portfolio.
And they'll still expect to hit the return objectives because they anticipate that some of those borrowers, given the rates that they're paying, are going to have challenges.
That's right. In one case, one of our fund managers has said they had looked at First Brands and there had been a lot of red flags that had popped up and had deliberately avoided that. And one of the things that they look for example, is a private equity owner of that business. And First Brands didn't have that. Where you have a private equity owner, they're obviously highly incentivized to make sure that their equity is protected and fraud and things like that are minimized.
Yeah.
So,
Well, a fraud will wipe out their equity very quickly and
Absolutely.
potentially the debt as well. So fair to say you remain enthusiastic on the sector, but appropriately cautious.
yeah, I'm not going in with eyes closed. I know exactly what I'm getting into and looking for managers that can navigate through what will eventually be a more challenging economic environment.
But if you have a credit manager out there that's offering you double-digit returns for cash-like risk, there's clearly red flags all over that one.
Yeah, absolutely.
Excellent summary, as always, Nick. Thank you very much. And thank you to all our listeners.